Hello, good morning, everyone. Thank you for joining us this morning. We are so glad that you could join us for this yet another edition of our training. This morning, we are privileged to have one of our very own members in the Vice President's Club, NCBA, sponsoring this event. So you're welcome. Take your seats. I'm the General Manager of the American Chamber of Commerce. This morning, the training topic is the role of asset finance and bank assurance in unlocking business opportunities. And we are very privileged to have two great minds in this sector that are going to take us through the training session. Now, in the recent past, as you all know, that businesses have been forced to rethink and look at how to conduct their businesses because of the pandemic and how they can win more businesses. The changing landscape definitely calls for businesses to make smarter and faster landing decisions, while at the same time ensuring greater productivity and superior customer care. We can debate on what are the various tools that can set businesses apart in that space. And that is why we have the best people to take us through this morning, to take us through the role of asset finance and bank assurance in unlocking business opportunities. So Henry, please, if you're there, I would like to invite you to give a few remarks and then straight away hand over to Anthony. And then Anthony, you will hand over to me to introduce Mark. Or you can even introduce Mark, Anthony, then we just start this training session.
Thank you, Anne. It's a pleasure to be here today on behalf of the board members with AmCham, our president who is away today, Mike Davis. I'm sitting in for everybody, but I'd like to welcome our vice president member, NC Bank, for helping us to take on this training, which is much needed, especially in this time. So good morning, ladies and gentlemen, keeping all protocols. It's a great pleasure to welcome you on this online training, the role of asset financing and bank assurance in unlocking business opportunities. I would like to thank the Vice President's Club, NCBA Bank, for partnering with us and accepting to sponsor this event this morning. As you know, asset financing is simply a 12 to 60-month facility that allows you to acquire movable assets like plants, machinery, motor vehicles, etc., that I think can all agree that asset financing space is evolving and changing quickly due to the various reasons. 2020 has forced us to relook at how we conduct business. That is to say, make smarter, faster learning decisions while ensuring superior customer service. NCBA Bank has been doing asset financing for over 60 years now and is most experienced in the area. And this means that we have the best trainers today, and many businesses are using these financing options to grow and provide secure and easy way of getting working capital for their businesses. As for bank assurance, on the other hand, it's a partnership between a bank and an insurance company. The insurance company is allowed to sell its products to the bank's clients, and the bank can earn additional revenue by selling insurance products, while insurance companies can get to expand their customer base with less cost. This is a win-win situation for both entities, especially now that business is being looked at differently. As for bank assurance arrangements, widely spread in Europe, where the practice has a long history. European banks have been dominant on the global bank assurance market, And in December 2015, Allianz and Philip National Bank formed a joint venture through which Allianz gained access to over 660 commercial bank branches and 4 million customers located in the Philippines. Allianz SE is an insurance and asset management company based in Munich, which with a market cap of 105 billion as of June 28th of 2021, makes it one of the largest businesses in the world. Over the past few years, life insurance throughout Europe, Asia, Latin America have spent a huge sum to secure distribution agreements with major banks. This trend is likely to continue elsewhere in other markets. And as AmCham, we would like to take this opportunity to encourage you to listen and learn from those who have been at this business for over 60 years and unlocking new business opportunities. I would like to introduce Anthony to come on and help us position what the bank is providing and what products they are willing to do for us. Thank you.
Thank you so much, Kevin, for those remarks. And now, right now, I would like to invite Mark. Mark Muyobo is the Executive Director, Corporate Banking and Structured Solutions at NCBA Bank. Mark is a fellow of the Association of Chartered Accountants, and he has over 20 years experience in the financial and audit services sectors. Mark, please take on the floor, and you can also tell us more about yourself. Over to you, Mark.
Thank you very much, Anne. It's a pleasure for me to be here. And first of all, I'll start by passing on apologies from Managing Director, Anthony Ndegwa, who has not been able to join us today as he is traveling. But we hope that we'll have a good discussion today. Hoping that Anne, you're able to share the presentation, if you could. Okay, so members of AmCham, customers and colleagues, ladies and gentlemen, it is a pleasure to be part of this training session. As NCBA, we are delighted to be part and parcel of coming to talk to you members about the role of asset finance and bancassurance in unlocking business opportunities. Before I delve into the training, I just want to spend a few minutes to talk about NCBA and who we are. NCBA is built on an ambition of driving collaboration, commitment, and innovation, with inspiring greatness and inspiring greatness is built on the NCBA DNA. A year ago, there was a merger between two institutions in Uganda, NC and CBA, to come up with the NCBA that brings together a best of two worlds. NCBA is wholly owned by NCBA Group, which is listed on the Nairobi Stock Exchange and has a presence in about 5 countries within the region, with over 100 branches and 100 ATMs as well. This means that NCBA and all the customers of NCBA are part of the most universal yet personal bank in East Africa. Sorry. So next slide, Anne. So our branch network, as I mentioned, extends 5 countries: Uganda, Kenya, Tanzania, Rwanda, and Ivory Coast, and more than customers, and arguably a bank with the most customers in Africa. So members I'll go into the next slide, which is the start of the training today. And the COVID pandemic has taught us as companies and individuals that you must preserve cash, you must preserve capital, and you must be efficient in your cash flows. And as NCBA, one of the solutions that are available for customers or for members of the public to utilize is the asset finance solution. And the asset finance solution is a solution where we offer the operating lease and finance lease. So I'll go into the detail as far as what is an operating lease and what is a finance lease. But for the benefit of just introducing this product, I will also go into what are the solutions that we actually provide. So what exactly is asset finance? Asset finance is financing of anything movable. So anything that is movable can be financed under the asset finance facility. So what are some of the assets that we can finance? They're motor vehicles, IT equipment, medical equipment, construction equipment, industrial equipment, and other movable assets. So the benefit of asset finance is mainly that you don't have a huge capital outflow in the beginning. And as I mentioned, the COVID pandemic, and even before the COVID pandemic came, in order for you to conserve your cash flows, you need to ensure that you actually plan for your cash flows. So if you have a huge equipment or huge asset that you would want to finance, in order for you to conserve your cash flows, you do not have to have the huge capital outflow at the beginning. The asset finance product as well gives you an ability to have asset management solutions like tracking of the asset that has been financed. So if you have a fleet of vehicles, you are able to track and ensure that these vehicles are actually being used for the purpose that they were financed for. There's the other benefit of tax deductions as a lease expense, and also the flexibility to renew leases and get new assets. So members, the biggest challenge, of course, as equipment is that it gets to a time when your equipment actually has now started being inefficient. So with the operating lease and finance lease, you are able to renew the assets without any problem. Of course, there's also the flexibility of the lease structuring. And the flexibility of the lease structuring, I mean that you can either do a step up or step down lease depending on the cash flows that you're actually getting. So let's take an example. If you are bringing in a machine that you know in the initial stages will not create the cash flows that you expect to come through because of maybe your marketing of a new product, your distribution of a new product, and you know that it will gradually increase, you can be able to structure a step-up lease whereby you start paying a little amount and then step that up to an amount which you can be able to afford. And of course, VAT on these assets is spread over a long period of time, over the lease period. And I just want to spend some time on that. So if you don't take a lease and you pay the facility, or you pay for the asset in one lump sum, you are paying the VAT as a lump sum. Yet, if you take a lease, the bank will pay the VAT as a lump sum on your behalf, and then recover it from you over the period of the lease. So the next slide actually gives us an indication of the bank assurance. And bank assurance, of course, is an opportunity for us to, as a bank, to actually provide insurance solutions. And some of the products that we actually have for our personal insurance and also business insurance, and they're actually listed there. And I'll not go through each of them in the interest of time. So the next item I want to talk about is what are our target sectors. So our target sectors, of course, in those areas that have been indicated there. I think manufacturing, we are very keen in supporting customers who would actually want to increase on their capacity locally. Import substitution is something which is of great interest to us. You cannot talk about asset finance without talking about construction, transport, and logistics. As a landlocked country, we depend a lot on the land, on the roads. Most of what is imported comes through our borders. So there is a lot of transportation or logistics that is required. So that is an area that we actually are very keen on looking at. Oil and gas is the other sector that we are very keen on. With the discovery of oil in the Albertine region, we support any linkages to the two principles in the oil and gas, upstream oil and gas sector, which is Total and CNOOC. And then any midstream and downstream, of course, the oil marketing team, oil marketing companies. Of course, commercial agriculture. Uganda is an agriculture state, and we particularly look at secondary agriculture and the value chain, financial and non-financial organizations, and also the public sector. The public sector and government agencies is the other sector that we look at. So there we have pictures of some of the assets that we are able to finance. But just to recap, asset finance is financing of any movable assets, and we take that as the primary security. In most cases, we finance. The customer contributes up to 40% of the cost of the equipment, and then we finance the balance. So with that, moderator, that ends a short presentation. I would suggest that there is quite a bit of interaction and questions so that we can be able to understand this product or solution much better. Thank you very much, and over to you, Anne.
Thank you so much, Mark, for taking us through that session. I believe that our participants here right now, they know what kinds of assets you can finance, and the kind of businesses like those dealing in trade and commerce. So I would like us to straight away have our next trainer, who is a good friend of the AmCham family, because he has been with us throughout before COVID, and even when we moved virtually. He has been one of those who never lets us down whenever we reach out to him. Paul Kavuma, who is the Chief Executive Officer of Uganda Insurers Association. Thank you, Paul, for accepting our invitation every time we invite you. Paul has over 20 years experience from both the insurer and the broking side. I would like Paul to tell us more about what he does best and also specifically bancassurance. And then after that, we shall go into the Q&A. Kindly prepare your questions and be very specific on whom you want to respond to your questions.
So, Anne, should I go? Thank you.
Yes.
Thank you very much.
Yes.
Thank you very much, Anne, and thank you, the American Chamber of Business, for this opportunity. It's always a pleasure to be a part of such discussions. And I mean, we couldn't have a better opportunity than this. You know, these are very unprecedented times, and we want to see that we promote each other in terms of business creation and protection. Amazingly, just this morning, we were attending a bancassurance meeting between insurers and the principal officers of the banks, you know, in trying to, you know, try and promote and get strategies to promote this. Mark, thank you very much for sponsoring this event, and we're really very grateful. Your absence was very conspicuous this morning because I expected to see you there, but I know you're probably preparing for this. But anyway, thanks a lot. It's only that, you know, when you talk about insurance, more often it has to generate a debate, and I guess this is going to be no different. But the good thing is that I have Mark, you know, because this is bancassurance. It's a relationship between insurers and banks. So Mark, you are my insulation this morning. So firstly, before we go into the presentation, I would just wish to, you know, bring this into perspective. The first traces of bancassurance were in France in 1980. Amazingly, it's just a phenomenon that is as old as any of us on this forum. So, but it's mutated into, I mean, whatever stats that Henry gave when he was, you know, opening up really puts this into perspective. Then on a local scene, you know, we have 20 banks that are registered to do bancassurance, and then we have 30 insurers that are eligible to do so. Banks can spread their risks amongst these insurers, which is a good thing. Why bancassurance? I mean, for us as insurers, we look at the banks. You know, the banks have a rich vein of customer data. They literally beat us hands down in terms of their production, in terms of customer. They equally have a rich vein of branch network. You know, I mean, now we even look at the agency banking as well. You know, it's one of those things. Innovation and product platforms. I mean, innovations in terms of providing platforms for banks is quite good in accordance with the banks. And of course, banking is more palatable. You know, it's a cash business, and ours is a promise business. So it becomes a bit of a challenge when we have to sell a promise. But the good thing is that we're looking at the banks to sell this. I would wish to go back to the first slide, the opening one. I mean, I need to, you know, throw a jab at Mark at this one. I think we had changed the presentation, but anyway, regardless, I wanted just to show, you know, to showcase the initial license that we got, and I would want Mark to ignore the person who was on the right-hand side, who was Patrick Mihira of Stanbic Bank. No pun intended. This is an NCBA event, but at least we would have concentrated on the regulator who actually gave the first license, and we concentrate our eyes on the image of the placard. But we can straight away go into the presentation of the training. I want to make this more of a discussion than a training, because the training gives the impression that we're actually in class. So first slide, just a minute, just go back a bit. This one. No, the one that's next, because we just want to deep dive right into the training. I mean, into the discussion. So bancassurance is a distribution of insurance products with a branch distribution channels. Like I said, the bankers have a rich vein of customer base, database, as well as the branch network, and now lately agency banking. So you can imagine, you know, the sort of distribution network that we have. If we merge the two, certainly the uptake of insurance will increase. The current penetration of insurance is only less than 1%. So we have 99% of the public uninsured. So if we are to, you know, exploit bancassurance to its full potential, then I am sure that we'll be attaining a lot. So the bankers and the insurers are able to plan their products that suit the customer needs. Like I said, the bank's business is cash, and cash has a natural attraction to the customer, whereas insurance is a promise. So what it ideally means here is that we don't have to do a lot of persuasion for the customer to buy insurance. The bankers would already have done that for us, and they would just embed their products within their product offering that would include insurance. So bancassurance also complements the traditional distribution channels for insurance. I mean, ours is a brick and mortar, but the bankers have, like I said, the networks, the distributions, the platforms. It just creates the convenience for the customer to access insurances through a one-stop, with the banks. Then the digitalization. On our executive committee, we always have bancassurance as one of the agenda items, and what comes to the fore is innovation. We have seen a situation whereby, even us as the insurers, we are lagging behind in terms of innovation. The bankers are way ahead. I mean, each bank has a wallet to bank to wallet, but you will find very few insurers that have that sort of application. So with the digitalization where the banks are miles ahead of us, I think this is also quite a good innovation for us to follow. Then ideally, bankers should be looking at this as a alternative source of revenue, as well as the insurers. Later on we'll see the premium figures, which show the significance of bancassurance. And in this particular instance, the bankers ideally earn the commission, and then it's extra income. Product innovation, we cannot echo this any further. It is just a means to satisfy the customer needs, whereby banks, like I said, deal with cash. And if you embed your insurance products within which the customers can appreciate, then it would be a good one. Then bancassurance models also assist the customers in terms of accessing insurance. And most importantly here is the reduction in cost of procuring the service. Because you walk into a bank and you don't have to go elsewhere. All your insurances, all your financial advisory is sorted out at the bank. So it is a good sort of a good benefit. Again, to record comprehensive financial advisory services under one roof. You go there for your personal loans, you go there for your corporate loans, and again, the insurance is thrown in there. Then easy access to claims management because of the regular visit to the banks. Insurers, it's phenomenal that when you buy cover, it is ideally rare that you'll find a customer coming back to you unless it is at the renewal time of the cover. But for the bankers, the access to the bank is quite frequent. So in the event of a claim, then you have easy access to your claim staff to see that your claim turns around. When as the insurers want to innovate, we usually have a challenge in terms of getting our products out there in the market. So our partnership with the Bancassurance and using theirs as a platform is an easy way for us to actually sell this. Lately, we have had the COVID-19 is a pandemic that has befallen us, and insurers have actually innovated and said, yes, we have a COVID medical relief cover. But it would be easier for us to sell it through the banks if we have embedded this under the bank products. So banking seems to be more palatable to the customer, and hence a more easier access to insurance products. And of course, customer feedback. We all struggle with getting customer feedback. Like I said again, the frequency of visits to the bank is more often, unlike an insurance company. So you're bound to see a lot of generation of customer feedback because of the frequency of visiting and the integrated system as well. Next slide. Because I want us to look at the significance of what bancassurance can do. Now, this is a slide that, for all intents and purposes, just shows the premium figures that have been generated between the 2 years, between 3 years, which is 18, 19, and 20. The industry aggregate premiums were in 2018, we had 790 billion. 2019, we had close to about 890 billion. And in 2020, we touched 970. But if we add the HMO premiums, which again are also regulated by the insurers, we finally crossed 1 trillion. So looking at the growth rates, certainly between 2019 and 2018, we were at an accelerated growth rate of about 14%. Even before then, it was oscillating between 12 and 14. Unfortunately, in 2020, where we experienced the first rigors of the COVID-19 to the economy, we had a dip in our growth, which was 8%. But again, I must commend our own resilience as insurers, because this was quite phenomenal. We had actually anticipated 50% in terms of our business turnaround. But to achieve 18% from 14%, I think is quite commendable. Then, of course, I wanted to show you the distribution of between life and non-life, whereby the growth rates are again quite reflective of what we are and what we're trying to do. But I want to draw particular attention in respect to this slide to the life segment. The life seems to have an accelerated growth rate. And when you look at it again, when you look at the last two lines for the bancassurance, again, you will see that life is also accelerated. So there's a natural attraction of bancassurance to life insurance. And ideally, a good model of a bancassurance sort of setup is ideally driven towards wealth creation. And wealth creation is more of life, is where primarily our life agenda is, whereby we try to grow the savings, we try to promote savings, and we try to promote investments under the life segment. So on the non-life, the businesses, you'll see a kink between 2018 and 2019, where the growth was 193. I mean, it's understandable. It was the first year of actually doing a complete cycle of business. And in this case, of course, the insurers already had businesses that were running with the banks, and these mutated into bancassurance. So it is not an artificial growth, but it was just placing the business where it rightfully belongs. And that then accounts for the growth. But you will see that on the life, it has been a steady growth. Now, yeah, next slide. Sorry, the next slide. Now, I know this is an extract from the previous slide, but we just want to draw our particular attention to what bancassurance, I mean, the significance of bancassurance. You know, in 2020, we had 20 banks that were licensed to undertake this business, and the premium between 2019 and 2020 grew in leaps and bounds. Ideally, the problem that we faced really is the pandemic, but otherwise, we were on a very positive trajectory. And like, again, I said, we cannot underscore the importance of life, whereby it contributes 72%. So we want to urge, and we've already urged our members under the life to do more product innovation, because this is a low-hanging fruit, and also the bancassurance as well to embrace this. So the overall contribution to bancassurance premium to our gross written premiums for the entire industry has progressively grown from 3% to 5% to 18% just in the period of those 3 years. And we anticipate that it's even going further. Unfortunately, I didn't have the media figures, but it would have showed a rather, good growth trajectory, because the insurance industry grew by 17% as of June. And certainly that must be reflective of how bancassurance has also grown, since it's a very good contributor to our growth. So next slide. Next slide, please. And could we go to the next slide? Yeah. Now, to bring this into perspective, sorry, the one that has the much sought after, the slide before this one. Yeah, this one. Now, the most sought after, oops, could you go back to the other slide? The other slide, this one, yeah. Now, to bring this discussion into perspective and what Mark actually, could you move to the next slide, please? Next slide. That one. Let's freeze it here. Now, to bring this into perspective on ideally what Mark touched and the product offering within the banks, this ideally sums it up and gives a generic sort of a description of what we are offering as the insurers. I want to look at bancassurance in the module that we know it. You're not going to go for the complex risks. Yes, there's a hunger, there's an appetite to go for the big complex risks. But the bancassurance module would be to first of all start with what customer base we have and how organically we can grow it. So ideally, the property damage against securities or collaterals that are placed with the banks is more often sought after. And this happens with the borrowers. So when you borrow and stake your property, it is automatically covered under bancassurance. And in this case, of course, the banks have to protect their interest and also invariably protect yours as well. So in the event of a total loss, at least there's a recovery of the loan. Then insurance for leased items. I mean, Mark has belabored that one. Again, there's an equitable interest between you, the bank that is leasing, and the lessee, who is the customer. So ideally, again, we have to protect that property against damage or total loss. Then marine cargo cover against letters of credit that are issued to facilitate importation of goods. Under the law, marine or imports, all imports coming to Uganda are supposed to be insured with local domicile insurance companies. The enforcement has been weak, but we're trying to work around this and with the stewardship of the regulator, as well as the Ministry of Finance and URA. So you're going to find a situation whereby when you issue a letter of credit to your client, they don't have to source insurance from the supplier end. They will have to source it locally. So this is another revenue for the banks to try and look at this. So when we were talking about the embedded the embedded products within the bank product offering, the banks would ideally go to a client within their database. It's not only receiving a loan or closing out on the loan, but also beneath the loan agreement, you will find embedded insurance products. And that's the best way to sell bancassurance. So within which you'll find personal accident injuries and funeral covers for account holders with a death benefit. This can be generic. Then also you will find the same products that have been offered for personal loans and group loans, where death benefit is also afforded. Then you will find embedded individual life products like the whole life covers, endowment covers, like education policies and savings, and midterm assurance. Now, I want to just delve a little bit on this one. This is where the wealth creation comes in, because we are looking at insurance as an alternative savings alternative means of savings, whereby when you look at this objectively, you can easily access your savings in a bank. But when you tie a long-term goal, whereby A, you have a whole life, A, you have investments, you have bonuses, certainly you're going to find it a bit more attractive. So the banks have embraced this. It's one of the covers that have actually propelled the life insurance sector in terms of production. And this has also been a very good redemption for personal financing during the COVID period, whereby people were laid off, people's incomes were cut, all sorts of things, whereby clients would then recall their policies. I know there's a surrender value, but at least to a very good extent, you have a mitigation. And where you are able to reinstate after a lapse period, you can agree with your insurer, and then you reinstate your cover so that you again attain the full term. So wealth creation in this regard is actually a very key facet of our bancassurance module. Then bancassurance should play a typical risk advisory role for the working clients, both provide a private and business sort of holistic risk covers. I want to take a situation where SMEs, for example, walk into a bank and you've been banking. Of course, you have to disassociate your own personal bankings and your business risks. But if you have a client who's an SME entrepreneur, then you as a bank can actually tie up all these risk covers, the property damage, the liability covers, accident injuries, assets personal assets like homes, cars, etc. So this already gives you a platform to see that you can actually generate A, cover, B, and also commission for yourselves as the bankers. And also, invariably, you are also offering a service to your bank client, whereby in the event of a risk, then the mitigation comes in. Like I said, during the COVID period, some of these policies were triggered, losses, that occurred, they were triggered, and actually business have been redeemed, out of risk currency and risk insurance. So in a nutshell, these are the most sought after risk covers that are generic, and that would actually ideally mitigate risk in the event of a currency. We go to the next slide, please. Now, of course, bancassurance has mutated ever since the first license was issued. And those were some of the discussion points this morning. Not to discourage or disparage interest into doing bancassurance, but of course, like any other line of business, I was telling my colleagues this morning in the breakfast meeting that the 4 years that we've been in operation as bancassurance practitioners, we have collected enough data to see that we do actually address our challenges. Of course, some of the challenges are regulatory in nature, whereby at the inception of any risk sort of provisioning, you must be wary of how this is going to pan out. And this is not different. So the regulatory environment from our side as the insurance sector is more often found to be a little stringent. And it's more often being found that it's not providing an enabling environment. But we are now seeing that concept morphing into a solid sort of offer, product offering. And we're seeing training needs that, with the association of the ITC, it's happening. Low market budgets, for to support the partners, to create the awareness. Already as insurance, the uptake is, the penetration is at is less than 1%. So how can we then, galvanize this? To sell your own bank products is one thing, but then to also convince your clients to actually appreciate insurance is another thing. So we want to see that we create synergies so that this is done. So then as well, embracing the culture of bancassurance within the banks, because this is not your core business. Your core business is to dispense money, look after people's money, invest it, loan it, and do all sorts of things with people's money. So when you then walk into bancassurance, yes, the motivation could be the commissions that are earned, but again, you have to nurture this into your culture so that then you avoid things like the high staff turnover, whereby it has to be found palatable for you to do this. When you have staff and you have set KPIs that do not embrace bancassurance in your culture, it might be a bit of a challenge. Of course, systems as well. On either side of the divide, we want to see that both the bankers and the insurers invest in digitalization and automated processes so that it's pretty much obvious and seamless. Then, of course, there's the hue and cry about competition with the brokers and the agents. This morning, we had a heated discussion on how internal bank risks should be managed. Should it be the bancassurance office or should it be a broker? We're trying to look at these as complex risks. I know we have on the call brokers, that would want to complement this discussion, but it's one of those things that we need to look at objectively, and if it's regulation driven, how then are we going to manage this? Is it stifling growth? The bancassurance should not be looking at this as a low-hanging fruit, but the low-hanging fruit for the banks is their customer database and their branch network. And now that has been complemented with the agency banking. So that should be a concentration area whereby you just satisfy the 80-20 rule. So as part of our engagement, of course, we have developed the Bancassurance Technical Committee, which is within the UBA hierarchy. And we are trying as much as possible to nurture them on our side as a UIA, to appreciate what the insurance offering is. We're also engaging them and helping them, approach our regulator in terms of the regulatory framework to make it a bit more appealing. What then should be the position on leased assets and customer choices on insurers? Because customers will have their own choices of insurance. Customers will have their own choices on who should be the producer of the business. But again, this is, a business that is actually entrenched in the bank. So how then do we draw a divide? The training needs have already been addressed. Product offering has always been addressed, and of course the collaboration with partners. We are trying to see that we do a sort of a capacity building, whereby we galvanize each other between the UBA and the UIA to see that at least on the floor, because since now we have bancassurance as a unifying factor, aside being both facets of within the financial services, we want to see that we actually use bancassurance to promote both associations as a lobby group for the public to appreciate. Could we go to the next slide, please? Next slide. Yeah, what future do we want to see? Again, no, just before that one, because this one is quite generic. It just shows, what future do we want to see? Full integration of the business and infrastructure and culture of the bank and culture within the bank. We want to see bancassurance coming to the fore. Yes, we know it's not part of the core business, but that has, in a way, inadvertently stifled the development of our distribution of insurance through you. Then the align the banker strategy into all your business channels, retail, commercial, and the digital space. Let's try and see that we organically grow, your client base, your strategies within which bancassurance can be embedded. Of course, you have the platforms. I mean, the bank to wallet, etc. Can we also plug in and get insurance to be, sold there? Then the target contribution on your side, on the banker's side, is from 5 to 15%. But on our side, we want to see a reciprocal sort of arrangement whereby the gross premium written through Bancassurance should also be reflective and also, cut into a bit more into our, our gross written premium. And of course, increase the financial inclusion through innovative products. This morning, I was telling my colleagues on the banker side that insurers, we tend to be a conservative lot, whereby, yes, we are used to the traditional products that we sell. And the bankers, the innovation space, the space between us and the bankers in terms of product innovation is night and day. That we have to be honest. The bankers are way miles ahead of us. So if we can partner and draw synergies within this and see that we can innovate on the growth and product development, I think we'll be taking ourselves miles ahead. So the last slide, which you could go to, is, that idea really shows which banks you can go to. These are the licensed members by the IRA. And I think now we've improved on our regulatory environment in terms of license renewal. It is a perpetual sort of licensing whereby it's 3 years and then a review is done. So at least you are rest assured that any of these banks, if approached, and you're a customer of any of these banks, you are certain to find insurance products within which you will have your risk mitigation done appropriately. So, Anne, thank you very much for giving me this opportunity. I hope I have done justice to what the expectations were, and knowing that, banks are more palatable in terms of their product offering, we shall piggyback right on them to see that we do actually sell more of our insurance products there. I thank you very much.
Thank you so much, Paul, for taking us through all what we need to know about Bancassurance. And right now, I open up this session for Q&A for those that have any burning questions. I've been seeing in the chats, but I could not really get out, John, from you what exactly you wanted. I don't see any specific question. And also at this point, I would like to request that when you're sending us questions, please be precise and tell us who you want to respond to your question. I would like to ask if anyone has a question, please, this is the time to send your questions via the chat so that we can go into the Q&A straight away. Okay, I do have some questions here. I will ask, and then Paul, between you and Mark, either of you can respond to it because it doesn't have a specific person. It says, what types? No, it's do businesses need a profitable trading history to qualify for the asset financing?
So, sorry, Anne, do you want us to take one at a time, or you're going to read them?
Yes, I would prefer that we do one at a time so that we exhaustively discuss it before we go to the next one.
Okay, thank you very much, Anne. And the asset finance facility is considered on a case-by-case basis. And of course, the organization being profitable is a key parameter to determine whether you are able to repay the facility or not. But of course, like there are quite a number of issues that may lead you not to be profitable, but we consider your cash flows. I think during my presentation, I I mentioned that one of the benefits of asset finance is that it manages your cash flow. It is a tool to manage your cash flow. So we really look at your cash flows and see whether you are able to repair the facility. So there are a number of issues that cause a company to be loss making. They could be having a large value of depreciation within the financials. They may be having some exchange losses within there, which really do not reflect whether that company is what is strong or not. So the key area that we look at is profitability. I think the other one is around the way the customer has actually been servicing their loans. It's important that members know that payment history is one of the key factors that determine whether you qualify for any banking facility or not. The willingness to pay. You may have the ability to pay, but when your willingness to pay is actually very, very low. So if you have good financials, but you're consistently in arrears with the financial institutions, then it affects your rating. So right now we have what we call the CRB, Credit Reference Bureau, that has the history of the performance of the customer. So we put all that into consideration to this facility or not. Thank you, Anne. Over to you.
Okay, thank you, Mark. That has been very clear, and I hope that the participants have taken note. There is, okay, John has made an observation that NCBA is not on the list of the licensed banks for bancassurance. Is it not licensed? Please do advise. Mark?
Yeah, and NCBA is licensed. I'm not sure whether Paul was using an old list.
my apologies, Mark. My apologies. I've not had myself a good lunch.
Yes, I am indeed just going to come for lunch from you, Paul, because
please,
NCBA
I will do the honors. And maybe, Anne, there was a question by John in the chat room. I just want to make an attempt whereby he's looking at the policy issuance and payment, and I mean the cycle towards that and achieving the actual policy, and then, you know, mutating into actual cover. Yes, there could be a process, but what we try to encourage the bancassurance module to do is to embed their policies within their product offering. So if you have a personal loan, then they're going to give you the covers that are within. If there's a healthcare element to it, if there's a life element to it, if there's a saving element to it, all that should be embedded within. And of course, the market conduct regulations require that even a bancassurance
Paul, you're
officer,
muted. We can't hear you.
No, I thought I was. Can you hear me now? Okay. Can you hear me now? Can you hear me now?
Yes, we can.
Okay, yeah.
Yes, Paul.
So in a nutshell, just to respond to the question, the sort of observation that John raised within, even the principal office of bancassurance is mandated to actually explain to the client what sort of products are, you know, embedded within whatever they're offering. And of course, we are under the cash and carry regime, which is a provision under the that yes, before you procure insurance, it's going to be cash up front, you know. So and yet we're migrating it to be done. So in a nutshell, yes, the processes should be such that when you are procuring insurance through a bank, it should be as seamless as much as possible. It should be an over-the-counter transaction. That's why we're looking to, you know, straight quick forward product offerings that are readily available, and then, you know, they mutate and turn around quickly. I hope I've attempted to respond to his observation. Thank you.
Yes, indeed, Paul. Thank you so much for that. We do have another question here for Mark. Okay, there is always a direct disconnection between the bank's general lending policy and asset finance product policy regarding security treatment. How can we cater for the security deficit on asset-based finance policy? That's a question from Geoffrey Okumu.
Okay, thank you very much, Geoffrey, for that question. As I mentioned in the beginning, that the assessment of any customer is done on a case-by-case basis. So you will find that a customer is in a risky sector that needs specialized equipment, and that customer has got the chance. If that customer defaults on the facility, the chances of actually recovering the funds that the bank has put into purchasing the equipment are low. So that's where the bank would then ask for additional security. What we do is, rather than ask for additional security, we could ask the customer to increase on their contribution. So by increasing on their contribution, that means that you're reducing the risk that, or reducing the investment that the bank is actually putting in. I said that the contributions from the customers actually go up to 40%, and we would then finance the balance. So as I mentioned, the facility is a cash flow management tool, where we could even ask the customer to increase their contribution. But also during the presentation, I talked about the flexibility around the structuring of the facility. So the structuring of the facility, we can even be able to do a short, a step down or step up lease, where a customer pays a little amount in the beginning and steps it up to a higher amount during the time when the machines or equipment has actually started producing capital, to enable the customer pay this comfortably. I think what I would encourage members is to go to any NCBA bank and have a discussion with the members at the branch, for them to actually understand what your need is and how we can be able to structure the facilities that you would require, because it is not one size fits all. We actually structure the facilities depending on what the customer's requirements are. Thank you.
That was very exhaustive. Thank you so much, Mark. There is, I think people are starting to repeat some of the things that you've already responded to, but I will just read this one for the sake, and if you want to add on to the question again, you can. Paul, it says, what type of assets can be financed and what kind of asset finance agreements are available? Maybe just a little bit more about the finance agreements, but you had both earlier discussed this. Mark,
thank you.
This is Mark.
Yes, thank you, Anne, and I'm happy to take that question. I think as far as the finance agreements are concerned, I mentioned that there is a finance lease and operating lease. The finance lease predominantly is around where the bank finances the asset. The customer uses the asset, and at the end of the lease period, the asset would revert to the customer. So in that case, the customer would contribute a certain percentage, which is usually up to 40%, and we finance up to 60%. You pay back the lease facility, and at the end of the lease facility, it reverts to you as the customer. The other one is the operating lease. The operating lease is different because while we come in with the customer, we finance up to close to about 100%. Now, at the end of the lease period, this asset would not revert to the customer, but would revert to the bank. So in the finance lease, the bank does not have the residual risk. In the operating lease, the bank would have a residual risk. So that is the major difference between the two asset finance agreements that we sign with customers. Thank you. I hope I've been able to answer that question that came in.
Mm-hmm. Just in connection to that, how long does asset finance take to arrange from the time you apply to when you receive?
So if the customer provides everything, we can structure an asset finance or asset-backed finance within a period of 2 weeks. Because as I mentioned, it is really a flexible structure whereby we actually look at your cash flows, we look at your financials, we look at your ability to pay, we look at the equipment, we inspect the equipment. Even though it is coming from abroad, we actually work with some of the agencies, inspection agencies, to certify that the assets have actually are in good working condition. And then we pay the supplier, and the supplier ships the equipment in countries. So it can even take up to 2 weeks to structure. There are even facilities we do within 2 days. So for instance, we have a few collaborations with some of the suppliers of motor vehicles in the country. So if somebody walks into the showroom of the vendor and everything stacks up, they would send that application to us. We would review it and we pay the vendor. So even up to 2 days, we are able to provide the asset finance solution. But as I mentioned, it is on a case-by-case basis, and we are happy to receive any requests for financing that may come from any members on this forum. Thank you.
Okay, I do not see any more questions. Let me ask the audience. Pardon?
We have one from John, and I think it's a very pertinent question that I can also, give a response. Of course, he is as a member of the private sector, he would wish to purchase more insurance, but of course, cash flow is also, to spread out the payments, to allow him to consume more and get more cover, which is really pertinent, because we don't want to make premium payments an inhibition to consumption of insurance. So ideally, there are just two solutions to this. The unfortunate bit is that we are under a cash and carry regime, and the market is not yet ready for the short-term payments and short-term covers because of the treaty restrictions. But of course, we are innovating around this. But however, the quick and immediate solution would be to seek premium financing. And I've seen members innovating on this, whereby if you went to NC Bank for financing, and I know they're quite strong on that. you can share the interest, because the interests are also quite, quite reasonable. So you can share the interest between yourselves and the underwriter. In the alternative, a good business relationship with your insurer will mandate and warrant that you actually get into a payment plan. The only thing is that in the event of a claim, let's say you have an annual policy and you agree on a 6 months payment. In the event of a claim at the 4th month, you'll be required then to bring your premium up to speed so that your claim is then addressed. That is the inhibition we've since had in terms of, aligning the sort of flexible payment, A, in regard to the law, and B, with our insurance treaties. Because the insurance treaties require that premiums are remitted for all risks declared on the borrowers every quarter. So that is the sort of inhibition we have. But I can assure you, John, there are flexibilities around this, and we want to promote as much insurance uptake as much as possible, despite the fact that, yes, we could have a strict premium payment regime, but there's room for negotiation and maneuvering on this. Thank you.
And if I could just also add, on top of what Paul's submission, there's also the third one, which I don't know whether Paul left out intentionally, but there is insurance premium finance that we provide. In that case, we would actually be able to pay the premiums in full to the insurance company, and then over the period, the customer pays over a period of 10 months. So in that case, it is actually a win-win for the insurance company, because you would get your full premiums. We would also pay of course, we would pay the insurance company. The customer will be able to not have any inconveniences in case there are any claims. And then you're able to pay back over a period of 10 months. That is also another solution that we can be able to structure. Thank you.
Thank you so much, Paul and Mark, for taking us through this session. Unless there are any burning questions, would like to say this has been a very successful training. And for those that still have questions, please feel free to reach out to NCBA Bank. You know where they are. If you have any questions on insurance, please reach out to Paul, and your questions will be answered. Please do not forget to fill out our feedback form, because we want to keep improving, and the only way we can do that is if we get your feedback. Otherwise, I would like to once again thank NCBA for taking this opportunity to sponsor our training. Please feel free to log out. We shall invite you for our next training and any other webinars that will come in the following months. But for today, this training has come to an end, and would like to thank our two formidable trainers for taking the time to be with us this morning. Have a great day, and see you next time.
Thank you, Anne. Thank you, Mark, for the
sponsorship. Thank you. Okay.
Yes, thank you. Thank you, Anne. Thank you, Paul.
Yes, thanks a lot.
How are you?
Fine.
What are you doing here?
Candice, what's that?
I brought you a small